Have you ever looked at a company's financial report and just your eyes glazed over? It feels like you're trying to read a completely different language, right? All this jargon, all these numbers. Well, today, we're going to crack that code. We are going to give you the keys to unlock the hidden story every single business tells through its financials. So take a look at these two numbers. You see a profit of nearly 50,000 ringgit. That sounds pretty good, doesn't it? Healthy for sure. But then you see 60,000 in cash. Wait, how does that work? How can a business make a certain amount in profit but have a totally different amount of cash in the bank? Is that good? Is it bad? This little puzzle is exactly why you can't judge a business on just one number alone. To really get how this all works, we're not going to talk about some giant corporation. We're going to follow a simple, fictional business for this whole explainer, Muar Cafe. By watching its journey, we're going to see exactly how all the different pieces of the financial puzzle snap together. Okay, so the first, most basic question anyone wants to know about their business is, are we actually making any money? The document that gives you the straight answer to that is the income statement. Think of the income statement. You might also hear it called a P&L for profit and loss. Think of it like a report card for your business. It doesn't tell you everything, but it gives you a score for a specific period of time, say for 1 year, telling you exactly how well the business did during that time. The way it works is actually pretty simple. I want you to picture a waterfall. Right at the very top, you've got all the money that came in from sales. That's your revenue. Then, as the water flows down, you take out the direct costs of making what you sold. The coffee beans, the milk for the lattes. What's left over? That's your gross profit. And finally, you subtract all the other costs of just keeping the lights on, rent, salaries, marketing, you name it, and what collects at the very bottom, well, that's the famous bottom line, your net profit. And here we go. These are the actual numbers for our Muar Cafe. They started the year with 200,000 ringgit in revenue. Awesome. After paying for all that coffee and food, their gross profit was 120,000. From that, we subtract operating costs like rent and paying the staff. That leaves an operating profit of 70,000. And then finally, after paying interest on any loans and paying their taxes, we land on our bottom line. And there it is. After every single bill was paid, Muar Cafe was left with a net profit of 49,400 ringgit for the year. So, the answer to our first big question is a definite yes. The cafe is profitable. But this is only chapter 1 of the story.
So, making a profit is great, fantastic even. But does the cafe have a massive mountain of debt? Does it actually own anything valuable? Just knowing your profit doesn't tell you a thing about your financial stability. For that, we've got to turn to our second key document, the balance sheet. Now, the balance sheet is built on this one simple, totally unbreakable rule. Everything has to balance. It all comes down to this core equation. Everything a company owns, its assets, has to equal all the claims against those assets. And those claims can only come from two places: money you owe to others, called liabilities, and the owner's own stake, which is called equity.
Let's break that down a bit. On one side of the equation, you have assets. These are all the valuable things the business owns, like the cash in its bank account, the inventory of coffee beans, and the big fancy espresso machine. Then, on the other side, you have how all that stuff was paid for. It was either funded by debt, like a bank loan, those are your liabilities, or it was funded by the owner putting their own money in. That's the equity. So let's look at Muar Cafe's assets. It's got 60,000 ringgit in cash. It has some accounts receivable, which is just a fancy way of saying money that customers still owe them, maybe for a big catering gig. Plus, it has its inventory and equipment. So you add it all up, and Muar Cafe owns a total of 125,000 ringgit worth of assets. Okay, so how did they pay for all that stuff? Well, the cafe has a loan from the bank and some accounts payable, which are basically just bills it owes to its suppliers, totaling 40,000 ringgit. The rest, that 85,000, is the owner's stake, the equity. And here is where the magic happens. You add those two up, and the total is exactly 125,000 ringgit. It balances perfectly. And this really gets to the core of it. The two sides don't just happen to be equal by chance. They have to balance. It is a fundamental rule of accounting. And what this gives us is a perfect snapshot of the company's financial health at one single moment in time.
All right, so we know the cafe is profitable, and we know its financial position is stable and balanced. But now we have to solve the original mystery. Why is the profit different from the cash? For that, we need our third and final document, the cash flow statement.
So let's get right back to our puzzle.
The income statement told us the profit was $49,400, but the balance sheet showed us there was $60,000 in cash. How is that possible? Well, the cash flow statement is the bridge that connects those two numbers. It is designed to do one thing and one thing only: track every single ringgit that actually moved in or out of the company's bank account. Now, this statement breaks down all cash movement into three main buckets. The first is cash from operating activities. This is all the cash that came in from the main business. Selling coffee, selling pastries. For Musa Cafe, its day-to-day operations actually brought in 51,400 ringgit of cold, hard cash.
The second bucket is investing activities. This is cash the business spent on big, long-term things to help it grow in the future. In this case, More Cafe bought a brand new espresso machine for 10,000 ringgit. That's cash leaving the business, so we show it as a negative number.
And the third and final bucket is financing activities. This tracks cash from things like taking out a new loan or paying back an old one. Here, the cafe got a net of 10,000 ringgit from its financing activities. So when you take the cash from operations, subtract the investment, and add the financing, you can perfectly explain the change in cash from the start of the year to the end. Mystery solved. So we've looked at all three statements, but we've kind of looked at them separately. The real power, the real understanding, comes when you see how they all connect. They aren't just three different reports, they're three chapters of the exact same story.
Here's how it all fits together. It's actually pretty elegant. First, that net profit number we found on the income statement, that number flows directly over to the balance sheet and it increases the owner's equity. Then, that same net profit figure is also the starting point for the cash flow statement, where we adjust it to find the real cash from operations. See? They all link together perfectly.
Here's a really great way to think about all this. Imagine your business is a big water tank. Revenue is the water pouring in from the top. All your expenses, those are little leaks where water is flowing out. The amount of water left in the tank at the end of the day, that's your profit. But the cash flow statement, that's like putting a little meter on the pipe itself. It doesn't care about the water level. It only measures the water that is actually moving. You can have a full tank, which looks great, but if that meter shows nothing is flowing, you've got a serious problem.
So what does this all mean for you? Well, here's your simple three-step health check for any business you look at. First, grab the income statement and ask, is it profitable? Step 2, look at the balance sheet and ask, is it financially stable? And finally, step 3, look at the cash flow statement and ask maybe the most important question of all, can it actually pay its bills?
There's a classic saying in the world of accounting that just captures this whole lesson perfectly. It goes, profit is an opinion, but cash is a fact. Profit is based on certain rules and accounting estimates, but the actual amount of cash in the bank, that's real, that's a hard fact, and that's why you can never ever ignore it.
Ultimately, these financial statements, they aren't just for accountants in back rooms. They are the language of business. They tell a story of ambition, of struggle, of success. And now that you have the key to understand this language, what stories are you going to uncover in the numbers?